It's 12:30, so I think we'll start the webinar. So hi everyone, welcome to the Q1 Carrington webinar. Today we're joined by Mo, our head of investments, and then also our special guest Sandy Pei, who is a fund manager at Federated Hermes, and we do hold two of the funds that she manages in our Carrington models. First, we've got the Asia ex-Japan equity, and then also the China equity fund. So I'm sure you've all seen the news in the recent weeks. It's been a very volatile world, and currently we're not short of talking points at all. So it's a great time to be joined by Sandy, who's going to provide her expertise, and we can discuss things all Asia and any other relevant topics. So as a reminder, please feel free to post any questions in the chat and we can address them at the end of the Q&A. So as I said, we're joined by Sandy. Sandy, it'd be great if you could introduce yourself to everyone.
Hi, everyone. I'm Sandy Pei. I work as the lead PM of the China Fund and Deputy PM of the Asia ex-Japan Fund at Federated Hermes.
Thank you, Sandy. So we'll get into the talking points. So we'll backtrack a little bit to the start of last year. So just a brief bit of context. So in the Carrington models, we actually started increasing our China exposure at the start of 2024 through the Asia ex-Japan Fund. Since then, China had a very strong 2024 where the Hang Seng Index outperformed the S&P. Sandy, great if you could give an overview of kind of the struggles that China went through in 2022, and then how they're able to have a very strong last year.
Sure, Lucas. So thank you for the question. If we take a step back of what happened in China, the market had a very strong rally, 52% return from January 2020 to February 2021. And then the market started getting into serious down cycle before a recovery in 2024. So what happened back in 2020 was the underlying economy in China was very strong. When the whole world was still under COVID-related lockdown, China was an open economy. So the country was making record high exports, and the local consumption was also booming. So you may even argue the underlying economy was almost too hot. GDP growth was mid-teen percentage in the first half of 2021. And that's when China started policy tightening from the second half of 2021. Then in 2022, when the rest of the world started getting into this reopening process, China, in contrary, moved into COVID-related lockdown. And that has resulted almost a year of disruption of business. And that created a huge issue for market. Property market, as I mentioned earlier, was already under policy tightening since 2021. And that COVID-related disruption resulted in even more liquidity issue for the sector. And then the reopening in 2023, it started strong, but faded very quickly. Why? Because during COVID, that 1 year loss of time, real business lost real money. There was never a cash handout to the household and the business who was suffering during that 1 year of lockdown. That's very different COVID policy in China compared to other countries. And with property price going down, stock market going down, there's also a wealth-related impact on consumer confidence. So in 2024, China got into a deflationary environment. There's a big consumption downgrade. So given all of those very challenging macro situation, surprisingly, the government didn't intervene. They didn't provide big stimulus until September 2024. That's when everything started changing. We believe the reason of why they didn't do stimulus immediately could be the following reasons. First, the central government do want to see a property market bubble burst. And second, they were very much concerned about longer-term issue of overcapacity if they do big stimulus. And finally, the central government wanted to teach local government a lesson about controlling their own budget and deficit. But because the underlying economy was suffering so much, they had to provide something. So you see the sudden pivot in September 2024. And what's interesting about that stimulus is historically, stimulus has been very physical policy driven. And for the first time ever, we start seeing consumption being included as one of the key stimulus policy for the government. That's a big change. And on top of policy support, physical, monetary, liquidity, everything, what also changed is the business regulatory environment. You probably have seen the news. There were two high-profile meetings between President Xi and business leaders. The first one happened in February. That's when he met a group of Chinese entrepreneurs talking about how to make China transit into high-end manufacturing and talking about support AI, etc. And the third one was in March. So he met a group of global CEOs, including companies such as HSBC, AstraZeneca, Samsung, Mercedes, Toyota, from all industries, all different countries, as also a strong signal that China is pro-business. So we believe the market is now expecting very strong policy support and a consistent business-friendly environment. Some people actually believe one of the reasons for Xi to delay certain stimulus or the bazooka, as everyone was expecting last year, is because the Trump uncertainty. The regulator want to leave more dry powder to see what's going to happen under the Trump administration, rather than playing all cards on the table at the same time. So definitely, if you look at the headline, policy support had big positive momentum impact for stock market. But if you actually look closer, you would notice the stock market already stabilized about half year before September policy pivot. And the reason is very simple. Policy rate in China is now about 1.5%, meaning Chinese households who are still sitting on large savings and growing savings, their choice is 1.5% from the bank, or they can invest in stock market. Because Chinese equity has been sold out for so long, they're so cheap, and there's improving payout and buyback, because management start buying back when they see such a cheap valuation. You have Hong Kong stock in aggregate were offering 4% return. Big companies like Alibaba, JD, shareholder plus dividend, 7 to 8% return. There's big difference between interest rate and equity yield. And that has triggered massive buying from onshore investor. So the Hong Kong stock market performance and the Chinese ADR performance is mostly driven by domestic money exploring that interest rate difference, and some hedge fund chasing performance. But we haven't seen a real change of long-only money. China still remains a big underweight for most of the long-only money today.
And then just touching on the stimulus, what were kind of some of the areas of the economy that you feel government were specifically targeting on how they're trying to transform their economy out of kind of an old manufacturing, potentially into this new type of economy superpower that seems that Beijing wants to become?
Okay. So if you look at the GDP composition, the biggest, like an elephant in the room, was property, right? And that was direct and indirect related in total 30% of the economy at the peak, and now has shrunk to 15%. High-end manufacturing, that includes things like robots, renewable, high-end computer, and electronic vehicle, etc. In aggregate, now is about 15% of the economy. That is growing very fast. So that will surpass property very, very quickly. The policy support we see today is mostly focusing on technology-heavy industry. And for consumption-related, it's still in early stage. Initially, it's on replacement, some consumption coupon, mostly goods related, home appliance, electronics, the products that have big domestic supply chain, so they are helping both consumer and manufacturer. But the recent talk is expansion into service related, and that will cover an even bigger part of the economy. For physical related, we don't expect big support on property. The government does want to see property becoming a smaller part of the economy, but you do see liquidity support for leading developers. So in 2021, during that tightening stage, they intentionally want to see sector consolidation. So some of developers were cut off from financing options. And now property price already dropped 40% from the top, and you've seen consolidation. The responsible ones now can get ample financing and to ensure that there's decent liquidity in the system. And for other more like more initial stage of discussion is social welfare reform. Aging demographic is issue for China. So you've seen selected province stepped up on child care support, and that may become a national program soon, because this is a very popular program to give people more money to let them have children. And also pension contribution. Talk about more contribution from the government and more healthcare coverage, everything to give consumer confidence to spend more.
Yeah, so as China kind of notorious savers, do you see kind of this transformation of the welfare structure in China maybe having an influence on more domestic capital flows into Chinese equities?
It's very possible. So that's why when remember, like when the initial tariff 20% was announced, on the day Hong Kong market actually went up, because 20% policy tariff was well expected, almost the base case or best case scenario for China. When Trump was elected, the scenario analysis was lowest 20%, highest 60%. So 20% was really not a surprise by the market. But now, given we are on 145%, why the market hadn't reacted more negatively? China has actually held up pretty well after this tariff announcement. I think that's for some people to bet on stronger and a faster response from the government.
And just backtracking a little bit, so we had the stimulus at the end of the year, well, Q3 2024. How did that influence other regions in Asia? There's kind of a classic comparison of China versus India. It'd be great to hear your thoughts on that.
So if we take a step back, like before the tariff announcement, right? A month ago, our Asia fund had substantial overweight of China and Korea, and a big underweight of Taiwan and India. That's before tariff. And the reason for that is valuation. So we don't have different opinion from top down or macro perspective for China, for India, Taiwan, Korea. We also like semiconductor in Taiwan, and we believe India has great potential as a country. We have the same view, but the issue is valuation. Valuation become very extreme for India. You have the India re-rating happened. So it's always expensive. We would never expect India to be as cheap as China or Korea, but even compared to its own history, it's at the very top end. And it's even more expensive than US companies who we believe have the best quality. And if you look at what sort of earning growth you can get, you are paying 60, 70 times PE for consumer stable companies generate a single-digit earnings growth. That's not high growth. So we just don't see any bottom-up opportunity in India, despite this very good macro backdrop. And for Taiwan, if you draw a stock market chart of Taiwan versus US S&P, they almost look identical. So of course, they have lots of the same supply chain similarities, AI, semi-driven. But as we know, semi is very cyclical business. Over a long time, it goes up. But during near term, 2 to 3 years, every 2 to 3 years, there's a cycle. Even before the tariff, if you look at earnings for Taiwan last year, there's a big earnings cut miss and guidance cut across sectors, because really apart from AI, nothing else was growing. So that technical industry cycle already happened, but there's continued re-rating. So companies reporting poor earnings make guidance cut, but stock make record high. And that's the reason of why we have big underweight of Taiwan. And under the tariff, those things have not changed. You may even argue this is incrementally more negative. It's not just negative for China and the US, it's negative for everyone. So you have both markets already facing their own cyclical challenges and very high starting point, and now facing additional earnings risk or downside. We just don't think the risk reward are attractive at the moment.
Okay, now moving on a bit more into the specific US-China trade war. So like you said, Trump has 145% tariffs on Chinese imports, and then China retaliated with 125% tariffs on US imports. So it seems like there's very little chance for resolution right around the corner, as they don't seem to be talking a whole lot to each other. Sandy, it'd be great if we could hear your views on what kind of leverage they might have on each other, and then how this relationship might look going forward in the near future.
I think the starting point for China and US are very, very different. We just talked about how China has suffered from 3-4 years of economic downturn. You really had all of the bad things happened in the same time. Property market went bust, right? And this China-US decoupling has been in the background for the past 8 years. So the global supply chain having China plus one strategy already hurt China's economy in the past 4 years. Even Chinese companies, they were investing aggressively in outside of China production, Vietnam, Mexico, Thailand, Malaysia, everywhere. And all of those investments do not generate GDP in China, right? So the damage is already done in China. But US is at a cyclical peak of their economic cycle. So really the reset for China is done incrementally. Yes, it will be more negative, but we don't think that would be a much bigger shock for China. And internally, she has full control. And there's, I would say, if you look at domestically, Chinese people are not questioning this retaliation. They just think this tariff is just too high and unreasonable. So if the policy lasts for longer term, I would say she would face much smaller domestic pressure and resistance. And if we talk about the policy dry powder, right? There's a lot he can do, both physically and monetarily. So we believe China has time on its side comparing to Trump. And therefore, it's very unlikely that she will blink first. And also, just because the tariff is so high, and that make it less practical. Say if the tariff was 30%, right? That number can be dealt with 3 parties sharing some of the pain. The manufacturer shares some of the losses, and the brand company shares some of the costs. Consumer shares some of the costs. Is workable. But with 145%, there's no longer solution. There's no point of even discussing this. So what will that happen is, we believe there are gonna be arbitrage in the market, because for business, there's no way that you can play an investment that normally need 10 years to get your return back, right? To invest today, because policy change every day. If you want to, like in the past, right, you invest in Vietnam, in Mexico, because it's low cost and low tariff territory. Why would you want to invest today when there's so much uncertainty? They may also face the same tariff problem. And even if you invest in the US, low end doesn't make sense at all. Even high end manufacturing, like a renewable and a semiconductor, Trump has canceled some of the subsidies and support for the manufacturers. They were not economical to start with without support, but and now you remove the support, it's even less economical. So the big background is there's no new capacity to be added to the system. So what would happen is very likely that demand will drop from 100 to say 80%. But that 80% you can't fill in by non-China supply only, because there's certainly not enough capacity. So you may see goods move from China to say Vietnam or Singapore, Mexico, wherever, and eventually flow to the US. And then you see higher costs for everyone, unnecessary cost, and consumer pay higher prices, and volume will drop as a result. But by the way, the US trade exposure for China is about 15% on paper. So it's big, but not that big. And if you even include indirect from other countries to US, that is 20% maximum. So the calculation sensitivity done by all of those economists now is about 1.5% to 2% impact on China GDP. And China GDP target is 5%. Some of that 1.5% can be offset by policy response from the government.
Okay, now turning the conversation to the Carrington portfolios. So given all this uncertainty, we managed to post some good Q1 numbers, but obviously things have changed quite significantly since Liberation Day. It'd be good if you give an overview of what Q1 looked like, and then more recently, if you could touch on that.
Yeah, so good afternoon, everyone. Thank you very much for joining. So yeah, I mean, look, the main heading for this webinar is Q1 update. Clearly, since the end of the quarter to now, quite a lot has happened in the market. So maybe I could just very quickly touch on Q1 itself. And as Lucas mentioned, that our relative performance was actually very good over that quarter, with the majority of the portfolios delivering positive returns, which was encouraging to see. So there are several things that we've already mentioned in our quarterly update, but just to sort of recap. Our general positioning, both in equities and outside of equities, was beneficial. So in the equity side, we had an overweight to markets outside of the US, and we had a couple of Sandy's funds, which have been very helpful to us during certainly the first quarter. And then on the non-equity bits, the big one's been gold for us. So gold's holding most portfolios in different ways. That's had I think it was gold has had its best quarter since 1986 or something, up about 20%. So that's been a really, really strong contributor. For the higher equity portfolios, we've also had the stocks that mine gold, so the gold mining equities, they've done exceptionally well as well. And so they've certainly helped to offset some of the weaker parts of the markets of the quarter. So all in all, good quarter. Fast forward to today, and certainly the last 10 days or so, 12 days, it's clearly been significantly more volatile. It sort of got to a situation where it wasn't quite like Q1, where some markets are doing well and others less well. This was more, an everything goes down type scenario. So there weren't many places to hide. However, having said that, again, portfolios on a relative basis did better than most of our peer group. So we're quite pleased to see those results. And what we're looking to do now is to try and take advantage of this sort of current situation. We've already communicated about a couple of the ideas that we have for portfolios, and how we can try and, as I said, take advantage from what is likely to continue to be a volatile period for markets over the coming months.
Great, thank you, Mo. So now moving on to our 2025 outlook. So obviously China had a pretty good Q1, driven by the AI sentiment following the release of the new AI DeepSeek, where They claim to produce a ChatGPT-like model at much lower cost, which kind of shook the US AI market slightly. So Sandy, it'd be great if we could hear your views on how you see the AI story playing out in China and how they can potentially use it to help dominate themselves against the US superpower within the artificial intelligence space.
I would say that DeepSeek event is more sentiment change than you see immediate economic impact. So the innovation in China hadn't stopped despite the sanctions by US. So China is developing its own semiconductor supply chain because China no longer have access to the most advanced chips. And China is making very good progress in logic and also in memory, even more so in memory. So there's a big localization. And you have this DeepSeek and other related companies making progress, showing China is still capable in innovating. And that's a big confidence boost. And in 2024, most companies, as a group, listed companies delivered around low-teen earnings growth. That's a very impressive number, but it's a result of low revenue growth and more earnings growth, meaning they were still in the saving mode, looking for cost efficiencies. But that DeepSeek event has changed investment sentiment. So you already see AI-related companies started investing again. That's a big change. So all of a sudden, people become more confident about the future. And the winner is very hard to see at the current stage. I think some people have moved away from buying a semiconductor NVIDIA basically as the only winner who can actually make money from AI. And now looking at about adoption, like who can make a new business model based on AI. So we have seen certain companies like a gaming company, they already included AI in the daily operations. That's relatively easier. And you see some of those Photoshop-alike companies, they start selling package and they are making money. But so far, there's no big business case scenario to justify a big economic upside. Definitely not at a cost of NVIDIA chip. But another thing for DeepSeek is the cost is so much lower, and that make the business scenario more broadly based. Before DeepSeek, it's almost impossible. Even the big guys, Google, Meta, etc., they can't get a business case scenario to justify investment. But when a cost is so much lower, even smaller companies can get into the game, and maybe some of them will get a business model that's profitable based on AI.
And then you previously mentioned that Xi Jinping was seen with business leaders such as HSBC or AstraZeneca. He was also photographed with Jack Ma.
Yes.
Do you see that as kind of an indication to the broader society that he is ready to kind of try propel this AI sector and they want to be the leaders of this?
Yes, we believe that was very significant change. So it's the only reason why Jack Ma was invited there was because she wants to send very clear and strong signal to the market that he is pro-business now. It doesn't mean Baba will get special treatment, but just saying even Jack Ma is forgiven now. And that is very, very significant change.
Okay. And then in terms of economic growth, the Chinese government, they've set quite an ambitious target of 5% GDP growth. Do you see the property market struggles being a drag on this, considering the consumption is fairly low?
So it was a very big drag. But if you look at what happened in the past 4 years, right, overall size has dropped. There's literally no new build in the past 4 years, very, very little new build. So it's about inventory digestion. So now inventory in tier 1 cities is about 12 to 15 a month. And the price we talk about already dropped 40% from the peak. And the inventory dropped from over 3 years long to now 1 year and a little bit. and you actually see transaction volume stay quite healthy for a secondary market. In certain cities, even primary listing now, you see price stabilizing or even increase. But I would say a price increase is very rare in quite selected area. Overall, the big adjustment are done, that 40% drop and that big inventory reduction. And the current market hadn't reflected potential buy from the government, because one solution is the government just buy big batch of inventory. So take even more from the market and use them for social housing. And that hadn't happened, but that may happen.
Did you see as kind of the stimulus being quite a key factor for them to reach their 5% a year target?
They will try to get that 5%, but I think most people's base case scenario is given the tariff related uncertainty, 4% is probably more reasonable, leave some room. But the government is quite keen on delivering, and they also want to give stability of the financial market. And that's why some people saying there's national team buying, but we believe there's economical reason for them to buy, because this one thing that you are certain in this environment is interest rate is not going to go up in China, potentially to be cut even more. And you still have that big interest rate versus equity yield difference. So there's economical reason for mainland China fund to buy, because insurance company do get inflow, and the mutual fund, when they issue yield products, they also get inflow. And for Chinese household, they have to invest somewhere, right? If not property market, now gold. All they can have is just stock market, and they buy these yield products.
Yeah. Moving away from the AI spending, China also very big spenders on renewable energy. How do you see the renewable energy sector playing out in the next few years in China?
So renewable industry had big growth during COVID period, and there's massive capacity built out. Over a long time, if you assume all countries want to reach carbon net zero and to achieve the promise they made on renewable being part of the overall electricity generation, there's no overcapacity. But the thing is that penetration or shift from traditional energy to renewable is very, very fast in China. 60% of the new cars sold in China today are EV. But the penetration, both for EV and generation mix, is happening very slowly outside of China. So in the meantime, that resulted overcapacity issue, because China already built a lot, but the rest of the world are not growing as fast as it should be based on those energy transition plan. So the renewable industry currently is suffering from temporary overcapacity issue. We believe there's room for the government to accelerate more transition within domestic market, and that can reduce some of the pressure for the manufacturers. And then you also see signs of bottoming, because the price has dropped so much. And only the leading companies are making cash profit now, which means you probably reached a cyclical bottom already.
Okay, thank you. So now moving on to a bit of a more general macro discussion. Mo, it'd be good to hear your thoughts on expectations moving forward. There are a lot of fears about a US recession due to the higher inflation and the tariffs. So what do you think is going to likely unfold? What are the key indicators you might be looking for?
Yeah, so look, I mean, clearly we're in a world now where it very much depends on which region you're talking about. As Sandy mentioned earlier, China and the US are at very different points in their cycles. So perhaps, I suppose, more importantly, certainly for the general markets and portfolios, is what's going on in the US. And at the moment, it's looking like interest rate policy may not change very much in the near term. whilst inflation expectations are rising, and there's a potential that if the tariff thing continues, that maybe we may get a slight uptick in inflation, and so that sort of general mix is not usually a positive one. We're looking closely at things like consumer confidence in the US, which is has a potential certainly to weaken off the back of what's happened. And in the US, which is very different to China, 70% of GDP is based on the consumer. So you really need consumers to be confident, and as soon as that starts to wane, that would impact spending and then the general economy and so on. And that's where things start to get a bit more tricky. So at the moment, it looks like that is maybe more of a likely scenario than it was, say, a month ago. But this is not going to happen overnight. These things sort of take time. You need to see sort of various data points come out over the course of this year and beyond. But clearly, we're going to be monitoring that very closely to see how we're going to be sort of tactical around that. So we feel this is an environment where we need to be much more active and tactical. So thankfully, we've had a lot less in the US compared to our peer group. We think now we may lean into a few areas on a short-term basis, and then maybe towards the latter end of the year, we start to sort of ease back again and look elsewhere. So that's the US. So specifically, outside of that, a real mixed bag and lots of uncertainty with all the tariff stuff. So we can't really have any strong views right now. But I think one thing is for sure is that we want to make sure that the portfolios are sufficiently diversified from a geographical perspective, because it's likely to continue to be volatile, I think, moving forwards.
Great, thanks, Mo. So we'll now move on to the Q&A session. So there's a question for you, Sandy. Do you see a world where these tariffs could actually strengthen China in the long run?
Tariff is bad. I can't say this is a good beneficial for China, but I would say in the past, there used to be easy money to be made in China. So I look at Asia, right? If you look at Koreans and the Taiwanese, because there's no big captive market, all they have is to be the best in what they do. So if you have the best products and best price, then you win global market. That's always been the case for Korean and the Taiwanese. They're great in what they do. But in China, there's big domestic market. If you are number one, number two in China, then you get market share, you got a cost advantage, and then you compete in global market. You don't have to be the best in technology or design. That was the case, but that has gradually changed in the past couple of years. If you look at the Chinese EV, they are selling not because they are cheap, because they are good. The spec is amazing and is cost competitive. I think there's general step up of quality R&D of Chinese companies. And because the domestic competition is so intensive, the one that survive this domestic market competition, they become even stronger in global market. So that is the big change. The game become harder for Chinese companies in the past couple of years, both due to geopolitical reason and also intensify the competition in domestic market. But longer run, you do see them really become globally competitive. And that semi supply chain setup in China, in the past, the high end is all done by Taiwan and Korea. China is still catching up, but you also see good progress in both design and manufacturing of semiconductor. And that also lay out a very good foundation for any high tech, the AI, robotic, etc.
And then just time for one more question. So obviously Trump wants manufacturing companies to rebase himself in the US. Do you think manufacturing plants in Asia have enough incentive to relocate to US at the moment?
There's definitely not enough there's no economic reason, let's say, there are not big enough incentive provided, and there's no policy continuity. So it's very, very hard for business leader to make that call. And that's why you see all companies are talking about this US diversification, but they're very slow in executing that. Say take TSMC as example, right? Of course, they know in this environment, they need ex-Taiwan capacity. They get it done in Japan very quickly because there are enough engineers, the people with right skill in Japan who can do this. And there's very strong government support in Japan, help TSMC ramp up the investment and production. But you don't have that in the US. There's a lot of regulatory hurdles. Even when they want to do that, it's not that easy. And this is TSMC, the highest quality, most high-end manufacturing. And imagine the green light they can get in the US. And if you're lower-end manufacturing, right, you don't get much support, and your margin, your cost difference, or your leadership is not big enough, it will be even trickier.
Great, thank you, Sandy. So I think we'll wrap things up there. So thank you very much for everyone joining. Thank you, Sandy, for providing your expertise today. It's been really interesting listening to your views on all things China, Asia, US. Certainly lots to talk about at the moment. And thanks to you, Mo.
Yeah, no, thank you very much, everyone, for joining. And thank you so much, Sandy. Really appreciate it.
Thank you. Bye. Good to be here.
Brilliant. Thank you, everyone.
Thank you.
Bye.
Thanks.